The United States issues the most powerful piece of paper on earth. The dollar prices most of the world's oil. It settles most international trade. Central banks from Europe to Asia stack it in their vaults as reserves. When markets panic, people don't run from the dollar. They run toward it and call it safety. But here's the paradox that almost nobody stops to really examine. If one country's currency sits at the center of the global system, is that a cheat code that lets it live beyond its means? Or is it a trap that forces it to bleed for everyone else's stability? Is dollar hegemony the ultimate privilege, or a silent burden that grows heavier with every crisis? To answer that, you have to strip away the slogans, ignore the patriotic speeches, and follow the story from the beginning, when the old financial world was shattered and a new one was built almost from scratch. It begins in the middle of a war. In 1944, with World War II still raging, delegates from 44 nations traveled to a remote hotel in Bretton Woods, New Hampshire. Europe was bombed out. Asia was devastated. The old financial center London was broke and exhausted. Empires that had once ruled oceans now struggled to feed their own people. But across the Atlantic, one country looked very different. Its factories were running. Its banks were solvent. Its gold reserves were the largest on earth. Its industrial capacity dwarfed that of any rival. That country was the United States. Bretton Woods was, at its core, a quiet admission of that reality. The agreement the world signed there rewired the global monetary system. On paper, it sounded elegant. Every major currency would peg itself to the dollar, and the dollar would peg itself to gold at $35 an ounce. If you were a foreign central bank, you didn't have to trust American politicians. You could trust American gold. You could, in theory, convert your dollars into metal on demand. A hierarchy of money was born. At the top sat gold. Beneath it, the dollar, as good as gold. Beneath that, all other currencies link not to metal, but to the American promise. At first, it looked like a system of stability. In reality, it was the birth of a new form of empire. Not an empire of colonies and gunboats, but an empire of invoices, contracts, and reserves. If you wanted to rebuild after the war, you needed dollars. If you wanted to trade, you needed dollars. If you wanted to plug back into the global economy, you did it through Washington's currency. The Marshall Plan, Reconstruction loans, military spending overseas, all poured dollars into a broken world. American factories shipped cars, steel, machinery, food. Dollars flowed out with them like blood pumping into new veins. Slowly and quietly, the world's financial nervous system rewired itself around a single point, the green paper issued by the United States. But hidden inside this new privilege was a structural flaw that would surface again and again. If the world needed dollars to function, where would they come from? They could only come from one place. The United States had to supply the world with its currency. That meant running persistent trade deficits, sending more dollars out than it pulled back in. It meant lending, investing, and spending abroad on a massive scale. From the outside, this looked like generosity and leadership. From the inside, it created a strange tension. The more the world depended on dollars, the more claims the world accumulated on American wealth. At some point, foreign central banks, especially in Europe, began to notice something uncomfortable. There were more dollars circulating abroad than there was gold in American vaults to back them. That tension even got a name, the Triffin dilemma. To keep the system going, the reserve currency issuer has to supply the world with liquidity. But the more it does, the weaker its own position becomes. To be the world's banker, you must lend. But if you lend too much, your promises start to look fragile. By the 1960s, the numbers no longer match the story. France famously sent warships to New York to collect its gold. Other nations murmured about exorbitant privilege, the phrase used by the French finance minister to describe America's ability to pay for imports with its own paper, while everyone else had to earn that paper through real exports. Finally, the illusion broke. In 1971, President Richard Nixon appeared on television and announced that the United States would temporarily suspend the convertibility of the dollar into gold. The word temporarily never ended. The link was severed. Foreign central banks could no longer show up at the Treasury's door and trade paper for metal. For most currencies, such a move would have been fatal. Trust would have evaporated. Capital would have fled. But the dollar was no ordinary currency. It sat on top of trade networks, military alliances, and institutions built in its image. Instead of collapsing, it mutated. If the dollar was no longer chained to gold, it needed a new anchor, something every country required, something they couldn't easily avoid or print themselves. The answer was energy. In the 1970s, after wars and oil shocks, a new deal was quietly forged with major oil producers, especially in the Persian Gulf. They would price their oil only in dollars. In return, they received security guarantees, weapons, and access to American markets. The dollars they earned would cycle back into U.S. financial assets, government bonds, stocks, real estate, weapons contracts. Thus, the petrodollar system took shape. If your country needed to run power plants, move trucks, fuel airplanes, or stay plugged into industrial civilization, you needed oil. And to buy oil, you needed dollars, not pounds, not francs, not pesos, dollars. To get those dollars, you had two choices. You could sell goods and services that the rest of the world wanted and earn them, or you could borrow them on global markets and debt contracts denominated in the American currency. The dollar was no longer tied to gold. It was tied to the bloodstream of the global economy itself. Oil contracts, trade invoices, loan agreements. Overwhelmingly, they spoke the language of the dollar. That is when the full force of dollar hegemony snapped into place. Seen from one angle, what followed was the ultimate privilege. When fear rises, investors rush toward dollars and U.S. government bonds. They treat them as the safest asset on offer, not because they are perfect, but because everything else looks worse. That demand allows the United States to borrow more cheaply than almost any other country. It can run deficits that would destroy a smaller nation. It can finance global military bases, social programs, and bailouts with IOUs the world is eager to hold. While other countries must earn dollars through exports, the United States can create them. It can import real goods, cars from Japan, electronics from Korea, machinery from Germany, raw materials from the global south, and pay with assets it manufactures in its own financial system. In that sense, America exports promises and paper. The world exports reality. There's another side to this privilege: power. If your banks, your payment systems, and your clearing networks sit at the center of global finance, you can turn access on and off. Modern sanctions are not just symbolic punishments. They are a kind of financial siege. A nation cut off from dollar payment channels suddenly finds its companies unable to transact, its banks frozen out, its reserves threatened. No empire in history ever wielded this kind of remote economic power. Armies once blockaded ports. Today, software can blockade accounts. From this perspective, dollar hegemony is like a crown made of pure leverage, cheaper borrowing, constant demand for your debt, and a financial weapon that operates at the level of code and contracts. But read the same system from a different angle, and another picture emerges. To supply the world with dollars, the United States must keep sending them out. Decade after decade, this means trade deficits, capital outflows, and a steady shift in the structure of the American economy. Manufacturing, once the backbone of national strength, begins to erode. It becomes cheaper and more profitable to offshore production to countries with lower wages and looser environmental rules, then import the finished goods back, paid for in the currency you control. The country at the center of the system slowly transitions from making things to managing flows. The financial sector swells. Wall Street's importance grows as global demand for safe dollar assets multiplies. The easiest way to satisfy that demand is not by building more factories, but by issuing more debt. U.S. government bonds become the backbone of the system. Pension funds, central banks, insurance companies, sovereign wealth funds all hunger for this paper. To feed that hunger, Washington runs persistent deficits. Tax revenues cover some spending. The rest is financed by selling bonds into a world that has no real alternative. Low interest rates are maintained in part to keep this debt machine affordable. That benefits borrowers and asset owners. It hurts savers and workers whose wages do not keep up with asset inflation. Meanwhile, other countries lock themselves into an export to America model. They keep their currencies deliberately cheap to remain competitive. They build factories geared toward U.S. consumers. The dollars they earn are recycled back into the American financial system, buying more bonds and stocks. It is a loop. Dollars go out to buy goods, goods come in, dollars go back out to buy debt. From 30,000 feet, the loop appears harmonious. Globalization, integration, mutual benefit. But on the ground, the distribution of costs and rewards is far from even. Inside the United States, entire regions built on manufacturing hollow out. Towns that once made steel, cars, and textiles see plants close and jobs vanish. Wages for many workers stagnate in real terms. At the same time, the prices of houses in financial centers, the value of stocks and other assets climb. Those who own assets watch their wealth grow. Those who live paycheck to paycheck watch the cost of entry rise. From their vantage point, dollar hegemony does not feel like a national victory. It feels like a quiet deal that favored finance over factories, global influence over local resilience. There is another burden that rarely makes it into speeches. When your currency is the world's reserve, your central bank does not just manage your own economy. Its decisions echo through every country that uses your money to borrow, trade, or save. When the Federal Reserve cuts interest rates to fight a recession at home, cheap dollars spill into emerging markets. Governments, corporations, and households abroad take on dollar-denominated debt because it looks affordable. Then, when the Fed later raises rates to fight inflation, those same borrowers face crushing repayment burdens in a suddenly stronger currency. This pattern is not an abstract theory. It is history. Aggressive rate hikes in the early 1980s helped tame inflation inside the United States. They also detonated a debt crisis across Latin America as countries that had borrowed heavily in dollars could no longer service their obligations. Later cycles of easy money and tightening contributed to crises in Asia in 1997, in Russia in 1998, and in other regions where dollar debts piled up on fragile foundations. In effect, the Federal Reserve is the unofficial central bank of the world, yet its legal mandate is purely domestic, stable prices and employment within the United States. The rest of the world is an afterthought, even though it is deeply exposed to American monetary swings it does not control. That mismatch between global impact and domestic mandate is part of the burden of hegemony. Every move designed to solve a problem at the center creates waves at the periphery. History also whispers a quieter, more unsettling message. No hegemonic currency has held the throne forever. Before the dollar ruled, the British pound sat at the core of global finance. London's bills of exchange, London's banks, London's navy underpinned trade. Before that, the Dutch guilder dominated. Before that, regional financial centers in Italy financed far-flung commerce. The pattern repeats. A rising power builds ships, factories, and networks. Its currency, backed by its productive strength, becomes trusted. The world begins to settle accounts in that unit. Its bonds are seen as safe. Foreigners treat them as stores of value. Success breeds confidence. Confidence breeds leverage. Leverage breeds excess. Debt mounts. Speculation grows. Wars are fought. Crises are mismanaged. Rivals rise. The old center clings to its prestige, even as the foundations beneath it crack. The currency does not collapse overnight. Instead, its share of trade and reserves declines over decades while alternatives slowly mature. The pound did not vanish when the dollar took over. It faded. The same logic applies to the dollar. Today, there are early signs of diversification. Central banks increase their gold holdings. Some countries settle trade in euros, yuan, or local currencies. New payment systems attempt to bypass traditional dollar-centric channels. Nations under sanctions search for ways around the American choke points. None of this overturns the system tomorrow. The network effects around the dollar are enormous. Multinational contracts, financial models, commodity markets, and reserve portfolios are all denominated in it. Changing that is like trying to change the language of global business. But the direction of travel matters. Every empire believes its moment is permanent. None have been right. So the question remains, is dollar hegemony a privilege or a burden? For the United States government, it is undeniably a privilege. It can borrow in its own currency, at scale, at low rates, while others scramble for the very units it creates. It can finance a global military presence without worrying about foreign exchange risk. It can weaponize access to its financial system against adversaries. For American elites tied into finance, global corporations, and asset markets, it is a privilege. Their balance sheets are written in the language the world is forced to use. They sit at the center of the largest pool of capital on earth, lubricated by a constant inflow of foreign savings. For American society as a whole, the answer is more complicated. The same system that keeps borrowing cheap also contributed to the offshoring of industries, the widening gap between financial wealth and labor income, and the long-term dependence on debt-fueled consumption rather than production-led growth. For the rest of the world, dollar hegemony is both a safety net and a leash. It offers a common unit of account that reduces friction in trade. It provides a deep, liquid market for reserves. In crises, holding dollars can be the difference between survival and collapse. But that safety comes with strings. Dollar dependence means vulnerability to decisions made in a foreign capital. It means living under a monetary climate you do not fully control. It means that in every crisis, you must ask not only what your own government will do, but what the Federal Reserve will decide in a meeting thousands of miles away. For you as an individual, the lesson is not to chant slogans for or against the dollar. It is to recognize that this invisible architecture shapes your daily life. If you live in the United States, dollar hegemony influences the price of the goods on your shelves, the interest rate on your mortgage, the kind of jobs available in your town, and the size of your government's promises. If you live outside the United States, your currency's strength or weakness, your country's access to credit, and the speed at which crises strike your economy are all tied, in part to a currency you do not vote on and a central bank you did not appoint. Dollar hegemony is not just about green paper and exchange rates. It is about power, dependence, stability, and fragility, all woven together. It is a privilege for some, a burden for others, and a double-edged sword for the nation that issues the money everyone else is forced to need. The system will not last forever. No empire's money ever has. But while it does, understanding it is a form of protection. Ignorance is the burden you do not have to carry. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.